Hello there, and welcome back, everybody. We are looking at monetary policy practice. Previously, we looked at monetary policy, and we looked at what it was, which was the Federal Reserve Bank, or the Central Bank of the United States. I know some people would say don't call it that, but I'm going to call it that. Using three different ways of increasing or decreasing the money supply, which we know can increase or decrease interest rates, which can increase or decrease the amount of investment and consumer spending, which can then affect aggregate demand, since aggregate demand is made up of consumer and investment spending. The three ways that we looked at this was increasing or decreasing the reserve requirement for banks, increasing or decreasing the discount rate of banks and the Federal Reserve, and then most importantly, the open market operations headed by the FOMC, the Federal Open Market Committee. And this is done by the buying and selling of government securities, or basically bonds, on the open market. So the Federal Reserve is buying these bonds from private lenders and sellers. That money gets put into the banks, of course, right? And then the banks have to, either keep a certain amount of that money on hand, and they can loan that money out, et cetera, et cetera. So that's how that money gets put into society. And then we have our fractional banking, which is that money that goes into banks then becomes more money as people borrow it. It gets loaned out, and then people take that borrowed money, put it in their bank, go buy something else, which gets put into somebody else's bank, which gets borrowed, but only some of it, because some of that money has to stay as a reserve requirement, et cetera, et cetera. And we see this multiplication process going throughout until each dollar is eventually reserved, or finally kept in the bank, or is loaned out. Okay, so money put into a bank can get multiplied, and we have our multiplier effect for that, and we're going to practice that today. One question I had from somebody was, does the Federal Reserve buy corporate bonds? Yes, it can. Sometimes it does, and sometimes it doesn't. We are in the middle of a pandemic crisis right now, and the Federal Reserve has done that. So it can happen, yes. So monetary policy, let's take a look at some of our practice. So let's not forget our multiplier here. And we're going to look at each one of these. So the first one says, and I want you to kind of pause the video here. So look at these, read through them. I have some of the important words underlined. So go ahead, read through that, pause the video, and then we'll go through them, okay? Be right back. Okay, and we are back. So we're going to go down here so we have a little writing room. And the first one was, if the reserve requirement is 0.5 and the Fed sells 10 million worth of bonds, so what will happen to the money supply? So we want to know money supply. What happens? Okay, is the money supply going to increase or decrease? We know that it is selling. So if the Federal Reserve is selling, we know that the money supply is going to decrease. Right? And if you're like, what? Why? Right? Well, we know the money supply is going to decrease because the Fed is selling bonds, right? So think of the Fed as this huge vault. It can either send out cash to society, or it can send out bonds to society. If it sends out cash, it wants bonds. If it sends out bonds, it wants cash. So if it's selling bonds or sending out bonds into society, it wants cash. So the money supply is going to decrease. By how much? Well, we know that 1 over our reserve requirement, so our money multiplier, or our multiplier in this case, is going to be 2. So it will decrease the money supply by 5, what's it, 10 million, 2, so $20 million. Okay. All right, number 2, if the reserve requirement is 0.1 and the Fed buys 10 million bonds, what will happen to the money supply? So we know that the money supply is going to go up because they're buying. So we know money supply is going to increase, but by how much? So we know we need to find our multiplier, which is 1. So this is 10. There's our multiplier. Okay, 10 million times 10, and that is going to give us an increase of $100 million. Okay? So the money supply will increase by $100 million. All right, last but not least is if the Fed decreases the reserve requirement from 0.5 to zero point 0.2, all right, what will happen to the money multiplier? So if we have that and we have this, right? So if a dollar goes into a bank here, 50 cents of it has to be held. If a dollar goes into a bank with a 20% reserve requirement, right, we know that only 20 cents will be held. In this case, it can only loan out 50 cents. In this case, it can loan out 80 cents. Right? So which one is going to increase the money supply more as it gets multiplied? If you chose this, yes, you are correct. So what would happen is the money multiplier would increase, because this is our money multiplier, right here. The money multiplier is 2, and the money multiplier here is 5. So the money supply would increase more here. Okay, why? Because as banks have to keep less on reserve, they can loan out more, right? And remember, banks make money loaning out money. That's one of the ways that they can make a lot of money. And so they do that, or collect leverage that way by loaning out money. And, well, we won't get into all that. We'll get into that later in a video. Okay, let's take a look at our last example. This is going to be a free response question taken from an AP question, but these are great. I like using these because I think they help kind of solidify a lot of things in a very short manner. So the practice is, I want you to read this practice question in the USA, and then those 3 questions, then pause the video, read those, answer them to the best of your ability, and then we'll get started on them, okay? Pause the video now. And we're back. So in the USA, I don't know why that is. There we go. In the USA, the reserve requirement ratio is 10%. Assume that the Federal Reserve sells. Okay, that's a key word. So we know that the money supply is going to decrease. Okay? So assume the bank sells $50 million in government securities. So already we know 10%. So we know our money multiplier is going to be... our money multiplier is going to be, if it's 10%, we know it's going to be 10, right? 1 over 0.1 equals 10. Okay, so we know money supply is decreasing. We know our multiplier is 10. Let's get that off right away. So using a correctly labeled graph of the money market, right? So we're going to do our graph, and our graph's going to look like this, all right? We're going to have quantity here. We're going to have interest rates here, nominal interest rates here. We're going to have our demand for money, and we're going to have our money supply. Why? Right? And we're going to have, I'll just make up we'll just call this IR. All right? Here, I like to give it a number. We'll just call it 5%. So using a correctly labeled graph of the money market, show the impact of the Fed's bond sale. Well, we don't know exactly what would happen, but we know that the money supply is going to decrease. So we're going to show that decrease. And we're going to have our money supply too. I should have gotten a different color. Yeah, oh, well, it's too late now. And we know that our interest rate is going to increase. And we'll just say, 7%. Okay? And that's basically all you have to do on that one. Okay, let's look at the second part of this question. What is the impact of the Fed's bond sale on equilibrium price? Okay, well, we look at our graph over there. I'll do an easy one over here. All right, we had this, and we said that the interest rate went up. So if interest rate goes up, we know, if this is investment and consumer spending, right, we know that if the rate goes up, that the quantity of investment and consumer spending is going to go down. So we know, I'm just going to graph it because it's easier to graph, right? We have aggregate demand, aggregate supply. Here's our price level. Here's our, and we'll just put our long run here. right? So we know we're going to have a decrease in aggregate demand, right? And it wants to know what is going to happen to the equilibrium price level in the short run. The price level in the short run should decrease. So price level should decrease, and I use that graph to kind of show you how I got there. Okay. Right. And that's kind of the point. Why would they want to decrease aggregate demand? Well, one of the mandates for Federal Reserve is to keep price levels stable. If they notice that the price level is increasing, let's imagine we're not at equilibrium. Let's imagine that we're like up here, right? And the price level is really high, right? They want to decrease aggregate demand, right? Because remember that Keynesian model, right, where we have this, right? Imagine our aggregate demand is here, right? And we have really high prices. One of the things that they would want to do is get aggregate demand to kind of go back down and release pressure on prices. Okay, that's the goal. All right, last one. If the USA, or in the USA, the reserve requirement is 10%, same thing. As a result of the price level change in part 2, are people with fixed incomes better off, worse off, or unaffected? All right. So if you have $100, right, and the price level is constantly going up, right, you have inflation, that's bad. If you have $100, because that's your fixed income, right, and finally they get the price level to kind of go down a little bit, right, your purchasing power just went up and you are happy. So are people with fixed incomes better off? They're better off. Why? Because prices are going down and their fixed income gives them greater purchasing power. That should make sense, right? They still have $100 or whatever it is that's fixed, but they can go farther or further, right? Okay. Hope that explained everything. If you have any questions on those, please let me know, and I will try to assist you as best I can. Until then.